I'll answer any questions regarding the trading challenge during the session. So I don't want to waste your time. Let us proceed. Okay, so as you know, theme this year is Mastering the Dow, Trading Strategies for the US Market. The duration is still 6 months, okay, excluding the registration setup that we did in month 1. We're going to be using the Microsoft forms that you guys have already been putting trades on and registering. Obviously, we're looking at all management students who are interested in finance and investment, and we want to give you an opportunity to develop a brand new skill. If you are participating as a team, then you can register on the specific Microsoft form as a boutique investment firm, and those can be teams of 2 to 5 members. We're going to be looking at specific trading and investment philosophies, especially during these sessions. We're going to look at quantitative, value, technical, fundamental, growth, and ESG. So if you have any questions for our trading expert, please do pop them into the chat, or you can open your mic. So the agenda for today is just a trading update quickly. So your share purchases that were done in the month of May, you'll receive confirmations by Monday. In the future, your share purchase confirmations will happen within 24 hours. We just had a bit of a technical delay there. As of Monday, you will have been allocated $500,000 virtually to allocate on the Dow 30. Again, if you are registering as a team, you want to register a boutique investment firm. We're going to look at the timeline, and then I'm going to hand over to our expert, Michael Grobler. We will have hourly breaks, and if we have 4 hours, but if we run out of questions, or if you guys are happy to conclude the session for today, we will conclude early. Okay, so phase 1 is the part we've already done. We have registered, and you've been provided with some foundational resources. You will now also receive your confirmation of your trades, so you can update your portfolio, and we will provide you with a video on how to specifically do that as well. Initially, you received 200,000 Rand in the first week of trading, and that was for the month of May. As of the 1st of June or the 2nd of June, you will have an additional $300,000 to allocate. The objective is to expand your portfolio with the additional capital. The final allocation of funding will be $500,000, and you'll receive that on the 1st of August, the 4th month of the challenge. And the final phase will be portfolio management and cash out. That's where we encourage you to finalize your portfolios and maximize your profits. That'll be from the 1st of September to the 31st of October. And that was when we will conclude in November, and we will make our winners announcements. You are obviously trying to maximize the profit on your portfolio. Now, without further ado, introducing Mr. Michael Grobler. You can open your mic when you're ready and share your screen. Michael is a derivatives and equities 30-year veteran of local and global markets. Okay, so I will close my mic.
Hey everybody. Just going to get our video. Okay, thanks so much for taking the time to join us. Put your volume down. Okay. Okay, hey guys, thanks a lot for joining us. I know it's early on a Saturday morning, so it says a lot about you for the guys, particularly who've joined us in real time. And then everyone who's taking the time to listen to these courses after the recording. I sincerely hope that you learned something from today and that I'm not intending to teach you how to trade. I want to teach you about trading, because once you enter the process with the correct mindset, you've got a much better chance of doing well in the long term. The stuff you learn in the beginning has a way of settling deeper in you than the new information. So if you start off with a bad set of principles, it can often send you on a path that leads you in the wrong direction for a very long time. So just so you know, I've been doing this for 30 years, but I'm not that old. I just started when I was young. Okay, so please feel free to type questions at any time. I'm not a very formal person in the sense of these kinds of things. You're very welcome to type anytime. You don't have to wait for a Q&A session at the end. You're very welcome to lead the direction that I take this into an area that you're of particular interest in. But we will cover a broad set of market principles. Are you seeing my value investing? Okay. So you'll see that we've got just a rough guideline we'll go through. It'll give you the basic principles of the respective trading ideologies. It can be quite a lot to take in, but the point is not really that you completely understand every single line item on these principles. It's just a guideline. You get different kinds of people in this world, and they all do their own thing in a different kind of way. Some people might be orientated to mathematics. Some people might be orientated to, art, which plays a role in finance through trading, believe it or not, in the form of charting. There are various different kinds of intelligence that can thrive here, not necessarily just pure financial know-how. You can have a strength of will alone that could drive you into a greater wealth than the smartest people you've ever met. So it's not really about the traditional approach. And that's really what we're going to try to help you understand before we even start to cover the topics that we will, the different ideologies. So I don't know if some of you maybe have easy equities accounts by now for real world trading. Maybe you've had a little bit of experience already. But if you just something to keep in mind, if you guys come out of this challenge, you've been successful or you've learned something, it's very easy to take it into the real world. There are very few barriers to entry now in the modern world. It's something that you can start capitalizing on if you feel it's the time. Okay, so I would like to tell you, a lot of people do not fundamentally understand why the market actually exists in the first place. And they don't understand why there are shares in the world and why they trade and what the point of it is and how it benefits the underlying company and how it benefits the role players in the system, because it's such a tremendously complicated system and it costs a fortune to manage. What is the point of all of it? So the idea is that a lot of people think of the market as a very exclusive place. It's got a lot of limits and preventative measures that stop people like you and me from getting into it in the first place. You either have to have a fortune of money, or you have to have, you need to know a guy, or you need to get a job in the industry, or you need to spend 14 years studying statistics, when it's actually completely the wrong idea. The reason why the market exists in the first place is, for example, if you had a company the size of Apple, that's $3 trillion of money. Now that's what it's worth. That's what its assets and its growth and its valuation is at this time. So imagine if there were no shares and the company sat in America and all the employees sat in their offices and they produced all these iPhones, and the company received its revenues every year and it turned it into net profit and disseminated it into society, and you'd have some economic growth. But what if during the time that the business actually exists, all of that money could be utilized in real time today? Instead of sitting in some old British banker's house doing absolutely nothing for the world. $3 trillion. So markets came into existence in order to liberate that money that would ordinarily sit dormantly, unproductively, economically unproductively. Now it's in the real world, and we can use it to create new technologies, to educate people, to move the world forward. We won't have to wait for some day in the distant future where some dead rich guy ends up giving it to some guy who doesn't deserve it in the first place, and nobody ever uses it. It never ends up of use. It's never usable energy. This is what markets were designed to do. And in doing this, they bring all the opportunities into the world that we have today. Unfortunately, you can't do anything without money in the real world, even if it's a really good cause. So access to the value of the US stock market at any given time is of tremendous benefit to all of mankind. Even if you're not an individual who's benefiting from a share price that's gone up. So you really, what markets are about from our perspective is financial freedom. The reality of the world that we live in is that it is a world comprised of systems, and the systems, every generation faces its respective set of systems. You can rage against the systems for as long as you like, you will fail. They are old, entrenched, and they only adapt very slowly. So the best thing you can do is acknowledge the set of systems within which you live, and then try to understand them, and if possible, master them. And then in the context of your life and in the time that you were born and the world that you live in, you will be able to thrive. We happen to live in a world where the market is by far the highest system. There is no government in the whole world, or religious force, or army, or facility, or institution, or militaries. They have nothing on markets. Markets can decide who has a good quality of life and who has a bad quality of life. If the market decides to destroy the Zimbabwean currency in 2 weeks, it will reduce the quality of life of Zimbabweans by 50% overnight for the next 25 years. And there's nothing they can do about it. That's the kind of power that these systems hold over us. It is extremely important, especially for a young person in the modern world, to come to understand these systems, like them or not. So, in this incredible big market, this most powerful system, it draws into it the smartest and most powerful and wealthiest and most educated and most productive members of our entire species. All of the wealthiest people you've ever heard of spend 90% of their time here. That's why they're the 90% richest. They got all the money. I think we're working with a couple of percentage points of the money at the moment. The rest of us, it's gotten so bad. You can still become quite wealthy with that couple of percent, but it would be a lot nicer for you and for everyone if they were to take the time to see if they could access the other 99% of the money. If you look at a guy like Bill Gates, most people think he got rich by selling software. He did not get rich by selling software. He got rich by owning shares of a company that sold software. This means that his wealth was never based on the software. It was entirely based on the shares. Now, you can't sell software, and I don't even know if you'd want to, but you can own stock. So all those things that separate you from Bill Gates are no longer. You can ride his coattails. You can follow these people. You can walk with them into the money. And there's never been a time in human history where you could do that with such a friction-free process. Now, the world's changed a lot since your parents and their parents ran the show. It's changed a heck of a lot. When your grandfather was a young man and your grandmother was a young woman, one man in the household could work. He could be a blue-collar worker, and he could live in a house in Humewood, and he could I'll answer that right now. Let me just have a look there. Um, this blue-collar worker could have a house that he had paid off. He could take the family on holiday for two times a year. He could have a car or two, and he could send his kids, all five of his kids, to school. But that is totally impossible now. We live in a completely different world where half the money in the entire world has been printed in the last couple of years. So the financial challenges that future generations suffer will be vastly in excess of that suffered by their grandparents and their parents. Even in my generation, in my early 40s, my very, very early 40s, we have felt the pain of this. The average American is leaving their house in their 30s now, whereas before it was in their late teens. There's no point in worrying about it. There's nothing we can do, but we can educate ourselves into benefiting from the outcomes that we can foresee that will result from these choices that this previous generation has made. If we fail to adapt, we'll have a serious problem. For example, if you look at the last, 50 years, US home prices have gone up by 1.5% per year. The stock exchange has gone up by 7.3% every single year. And a lot of people will have told you that the old traditional ways of making money, it's all about property and, you're never going to fail there. And they're not wrong. But they could be doing it 6 or 7 times faster. They just aren't aware of it. It means most of them are fairly well off, but very few of them are super rich. You can only become super rich in markets. Not an exclusive club. It's designed to allow everyone to receive access to shares and money, and it's it's incredible in that you could put 500 rand into the market and no one will know it was you. No one will care if you're black or white or a Christian or a woman or poor or rich, irrelevant. It's all the same to them. It's a truly fair and truly free place. And it prevents entrenched money from hiding away. It gives everyone access to it. And the second it comes onto the market, it becomes fair game. And now this money has a funny nature to it. It likes to go from weak hands into strong hands. I didn't say poor hands into rich hands. Weak hands into strong hands. Weak minds into strong minds. You don't have to be a successful person to get rich on the market. You just have to be a good investor. The rest of you, whatever makes you up and whatever you do in your life and in your world, if you're a garbage collector, the market doesn't care. Your trades don't care. If you make good trades, if you make good investments, if you use sound financial principles, you will outpace all of your friends because they can work as hard as they can. They can educate themselves into infinitum, but they will never be as productive as the forces that avail themselves to you on stock markets. It's like Warren Buffett says, compound interest is the greatest force in the universe. Newton said it before him. Okay, so let's have a look at some of the basic approaches. You get a different kind of group of people on the market. Let's just get your questions here quickly, actually, before we move there. Glad some of you guys have an account. The Argentinian economy turnaround. Yeah, look, I mean, that guy has taken a serious axe to everything in that entire country. He's like a crazy, mad little guy, but I think he's very fascinating and interesting. He's had a very big impact on their deficits and, he's turned their inflation around, etc. If you look quite deeply into the issue, you'll find that he is experiencing a lot of internal strife as a result. He's had to dismiss an enormous number of government employees, etc. So yeah, he is suffering a little on the inside there, but domestically, but I mean, I think he's fantastic. You're getting a lot of this in the world where you've got these crazies just sort of like just bashing everything in the system to try to turn things around. So yeah, you're getting a bit of that all over the world. You're getting a bit of people have run out a bit of patience in some of the countries, especially the socialist countries, the dictatorships that they are seemingly ending up as. And yeah, but I mean, this is a very interesting thing and a very positive thing for South America. But it's definitely going to be a painful process. It took 20 years to destroy the place, so it won't take a year to fix it. But yeah, judging by the energy levels exhibited by that culture, I think those people will be quick to recover if they have the right leadership. If he gets it right, he'll be quite famous for achieving that. Um, Okay, so guys, we're going to talk about value investing, guys and girls. Value investing is like one of the oldest of the different approaches. Markets are actually thousands of years old. So all the stuff we're going to talk about now is actually pretty new stuff at 100 years old. The value investing was originally theorized by a gent named Benjamin Graham, a very clever guy, and he was Warren Buffett's professor at university. Okay. So, value investing is a strategy focused on buying stocks trading below their intrinsic value, with the expectation that their market price will eventually reflect their true worth. Pioneered by Benjamin Graham and popularized by Warren Buffett, it emphasizes long-term thinking, discipline, and margin of safety. This lecture will cover the core principles, key metrics, practical steps, and challenges of value investing. Okay, so just a little background. There was a gentleman named Benjamin Graham. He was famous for, he used to be a lecturer at a university in America during a time when it was basically the Great Depression. So what he used to do was he was obviously a genius. So he used to write a few stock symbols on the whiteboard for the kids. And then at the beginning of every semester. And then the kids would go and tell their parents. And their parents would use what little money they had to buy those shares. And those shares would pay for the student's education for the semester. So at some point, a young gentleman named Warren Buffett ended up going to class and listening to a man named Benjamin Graham. And they became very close with one another. And Warren became his fifth apprentice. And he taught him about a concept called value investing. Warren Buffett, having received such a great tutorship from Ben, went on to become the greatest investor of all time. Very few people would disagree with that. A very interesting man. He lives in a very, very inexpensive home in America. He doesn't flaunt his wealth, but he's worth upwards of $200 billion. He's very calm man, and he's got a great mind, and he's got a great way of understanding sentiment and the human psychology. And then he's got a completely encyclopedic knowledge of finance and financial statements particularly. Something interesting about Buffett is that he's made about 99% of his wealth after his 50th birthday. So there's hope for you still. Okay, so core principles. We're talking here about margin of safety. I would consider the most core principle to value investing. So the idea is that you can't know exactly what the share's intrinsic value is. The intrinsic value is the true value of the stock and the assets that you're getting and the growth that you're getting. But the intrinsic value is a very who knows kind of number. It could be this, it could be this, it could change. So the idea is that you calculate something that's as close to the intrinsic value as possible. And then you put in a rule that says you can only buy at 20% below that value. That gives you a little safety precaution there, where it will allow for some falling of the stock, but without you being surprised, essentially. It will allow for some room for error on the assumption that your estimate of the stock's price has some kind of variability to it. You could be a little bit wrong. Also, if the market has inefficiently priced the stock could go down some more in the market locating that efficient price, and that could result in you taking a loss. So you're buying it on the assumption that it could go down a little bit more, but you're still going to get a good deal because you didn't even want it until a number about 20% below that number. Value investing is a very fundamentally based investment approach. They have very little interest in charts and pictures and that kind of thing. They're basically looking for a good value proposition. The kind of person who becomes a value investor is a business person. They want to get a good deal, they want to get a safe deal, and they want to have some prospect for growth in the future that is reasonable. And they also like the sense of taking advantage of an opportunity. This is an opportunistic group of people. They are capitalizing, they are capitalist in nature. And they are assuming that they know more than other people, because if they are buying shares that are value, which are often shares that have collapsed or fallen or performed badly, they are assuming that they know something someone else doesn't, that the value is maybe there in the business and the other people are not seeing this value. So, but they have patience. Heck of a lot of patience. They will wait 5 years if they have to for the value, what's called value unlock. Perhaps the shares turning around slowly, management changes, that kind of thing. They're willing to wait it out. And obviously, if you successfully employ this particular style of investing, you will ultimately be buying a bunch of pretty decent companies at pretty decent prices. And that's obviously going to work out in the long term. So you're trying to figure out what the company's worth. You're trying to figure out what it's worth based on its earnings and its assets and its growth prospects. When it comes to the earnings and the assets, that's easy. The problem is that a company is not just worth its assets minus its liabilities. It's worth all sorts of things. Coca-Cola is not just worth the factory that makes the Coca-Cola. It's worth the brand Coca-Cola. It's worth the potential growth into huge emerging markets. It's worth lots of things. The problem is that that's a very subjective kind of thing. Anyone could give you a number. There'll be something that's ridiculously expensive and something that's ridiculously cheap, and everyone will agree, but that range will be quite considerable. And you could make a whole career trading inside the time they're deciding what it's worth. So you get this margin of safety, you buy this value proposition. You hopefully have bought it at a significant discount to its intrinsic value, which is aiming to protect you from downside and your estimate error. So these are very pragmatic people, a lot like real business people. They deal with real world, real life stuff. This guy's like, okay, I'm probably wrong. Let me give myself a bit of room for error. I'm going to wait this out if it doesn't work. So this person is in no rush. When it comes to trading, like trading in the sense that you would be trading for this challenge at Varsity College, you can still use value, even though primarily it's worth, its primary worth is in the long term, simply because it takes a long time to turn the Titanic. If there's a big market business that is struggling, it's going to take a couple of months, if not years, to turn it around, and you're going to do really well. But the mindset that you require to be a value investor can be applied to shorter term trading. For example, if you have a stock that is maybe some bad event that's taken place. A good example was United Health, which is a Dow constituent which you can purchase in the competition. Someone shot their CEO the other day. And that made the share price start to fall really, really, really badly over a very short period of time. Even though the company is worth hundreds of billions of dollars, and while the event was terrible, it's not the result of some kind of collapse in demand for their product, or everyone's just decided not to have medical aid anymore. They will replace the manager, God rest his soul, with a new manager, and life will go on, and operations will be unimpacted. So, a simple example. You could purchase that company in that very short capitulation. Could take a day, 2 days. Share price could go down 25%. It did, in fact. So it's not so much how long you wait to get value. It's when you buy. Maybe that value was thrown at you very quickly. Maybe it took ages to die over the course of 3 years. Like Chevron has lost 10% of its value every year for the last 3 years. It hasn't collapsed off a cliff like United Health, but they're essentially both the same trade from an ideological perspective. They are big, good companies that have come down, and you are going to assume they will go up. The reason why I mention the value in regards to the competition is because if the share price has fallen down very quickly in a short period of time, it will tend to go up in a short period of time. So you can still take advantage of the mental processes that you would apply to purchasing a good long-term value investment to short-term investing. It doesn't matter how fast the opportunity took to happen. You've got to ask yourself whether it's an opportunity and then get on with it. Because it could take the market one day to realize they were being stupid yesterday. Or it could take 3 years. Okay, so we've mentioned the tendency to long-term perspective. This is a very good quote Buffett always has referenced. If you don't want to hold it for more than 10 years or for 10 years, why would you buy it? They're saying, do you think if you put this one, if the stock market was closed for 10 years and you bought a stock today, would you be comfortable to hold it? Would you be comfortable to hold a business? Maybe you think there's going to be no soft drinks in 10 years. They'll make it all illegal. Then you may not want to own Pepsi. Or I can't see a world where we don't have a JP Morgan in America in 10 years. So I'd be pretty comfortable to hold that for 10 years. These guys used to use a market analogy called Mr. Market. The reason why they mention him is because Mr. Market is a guy who used to come knock on your door every day. And he used to offer you stocks, all the stocks. Yes, Gaston, time in the market, 100%. Steinhoff was terrible. Terrible for a lot of guys, I know. So Mr. Market comes and knocks on your door every single day, and he offers you every single stock. But the cool thing about Mr. Market is you can treat him any way you like, and he never gets offended. You can beat him on the head and kick him out of your house. He'll be back tomorrow. If he comes back to you and he tries to rip you off, you can kick him off the stoop again. But he'll be back the next day. Eventually, Mr. Market will come to you with a decent opportunity, and you can take it. But remember, Mr. Market has no feelings. So you don't ever have to rush. You don't have to feel the need to rush into a stock. You don't have to feel that there's some kind of limit to the opportunities, and that if you don't do this now, you'll regret it for the rest of your life. Because Mr. Market's coming back tomorrow morning. He'll be back every single morning. More speed, less haste. There'll be a million opportunities for you to take advantage of. Choose the really good ones. Take your time. You won't live in regret. Lots of stocks go up all the time. There's about 60,000 stocks in the world. You know, you're always going to miss most of the profits. That's how it works. But you can change your mindset here in a lot of ways, because you actually have to invert the way that you think in markets to be successful in them. You have to learn how to solve problems in a negative fashion. So, for example, if you buy bonds, bonds will always pay out. A high quality bond will ultimately always pay out. It will, the only thing that would determine whether you made a loss or a profit is if you did something in between that time. But ultimately, the way you make money in bond trading is to simply avoid all the bonds that don't pay. Stocks are a very similar thing. It is the nature of the stock market to rise. You do not have to try to go out and find the next big thing. Go look at a chart of the S&P 500 for the last 100 years. It's bottom left, top right. That's it. If you just left your money in it, you'd be rich. You'd be old, but you'd be rich. If you simply avoid the bad stocks, if you avoid the things that work against you, you will thrive. This is very reflective of real life. It's really quite unnecessary to go searching everywhere for opportunity in life. All you really have to do is do your thing, avoid the disasters. Don't make any really stupid or rash decisions that destroy your situation. And for the most part, life has a way of working out. If you don't score too many own goals, the market is exactly the same. If you avoid the disaster shares, which is relatively easy, it's hard to find the next big thing because it hasn't happened yet. But it's pretty easy to see what's garbage and what's not. So if you avoid garbage, the mechanism of the market, which is designed by the rich to make them richer, will make you richer. Just get out of your own way. Value investing is about finding value propositions and avoiding shares that will continue to go down and will continue to go bankrupt ultimately, or shares that are extremely expensive and while they won't go bankrupt are actually a bad investment for you because you don't own the company, you own the share, and they are not exactly the same thing. With regard to the problem inversion with stocks as well, for example, an analogy Charlie Munger used to give. He was once tasked with working at a military base, and he was in charge of sending the pilots out to different regions to do different reconnaissance missions. So instead of trying to figure out, what's the best route and what's the best approach to this, he asked himself a very simple question. How can I kill my pilots? He then found out that the two biggest causes of pilot deaths during the war were iced up wings and running out of fuel. So he put all of his energy into making sure that he sent the planes to areas where their wings would not ice up and they would not run out of fuel. And he lost no pilots. If you eliminate the bad things, the good things will take care of themselves. Part of value investing and another section of the investing we'll cover called fundamental investing is ratios. So this is more traditional finance stuff. If you have a company that has a share price of 10 and that company produces 1 rand in earnings, net earnings, bottom line bucks at the end of the day, that company has a price to earnings ratio of 10, because it would take you 10 years of earnings to get to the share price. There are some companies in the world that trade at a price to earnings ratio of 2, and there are some that trade at a price to earnings ratio of 250. Why would they trade at 250? Because the market has super high expectations of them. If they disappoint, the share price will collapse. However, if they're at a price to earnings ratio of, say, for example, 100 today, and next year they double their earnings, then they will only be at a price to earnings ratio of 50, which then makes the 100 a little bit more logical at the time. People were pricing in the future growth and assuming that the price to earnings ratio would unwind from the earnings perspective instead of the price perspective. The price to book ratio is a similar concept, only instead of taking the share price and comparing it to the earnings, we are taking the share price and we are comparing it to the assets of the business. In the terminology of stocks, book means equity. So price to book of a company would mean that if it's got a price to book of 2, it means that its share price is double the price of its assets and its, or rather of its equity. This is a very important metric in things like banks or property companies, because property companies hold a large number of assets. So if you bought a property company that had a price to book of 2 and it had 10 properties that were worth $1 million each, you'd be paying $2 million each for the properties that you bought by buying the share. So if you want to get a good value proposition, you'd want to buy a share that was trading at a price to book below 1, because that means that you're paying 80 cents for a rand's worth of assets. Free cash flow, also referred to as oxygen. Free cash flow is a line item on financial statements that presents the reality of the situation of the company. When it comes to financial statements, accountants have very many ways of doing all sorts of creative and interesting things that make losses look like profits and small money look like big money. But the cash flow statement is financial. It is designed to be very difficult to manipulate. It's a very small line item. It's a very definitive, and all it's saying is how much did your bank balance go up by this year compared to last year? Did it go down or up? Because a company could take, for example, Amazon was famous for never earning any money for like 20 years. But obviously it was earning a fortune. So it's like, what's going on? Well, what was going on was they were reinvesting the money. So they were presenting on their financial statements that they were actually have no earnings, which is true, because it never got to the earnings part of the financials by the time they'd spent it back on themselves. But what they were doing was spending another $500 billion or whatever on themselves and making the assets bigger. So the shareholders were getting richer. They just weren't getting rich in cash. They were getting rich in assets. Who cares? But they weren't paying taxes because they weren't earning the money. It wasn't falling into earnings. This is how these companies become so large. They eat themselves. They don't give the money away. That's why the market is so important, because it takes it back from them, gives it to us, and gives us the opportunity to have it. Okay, tools, financial statements. Financial statements are obviously a set of numbers that comes out of a company, either quarterly, annually, semi-annually. giving all shareholders and all individuals that may have the right to see the document. It'll tell you absolutely everything about the company at a financial level, how they're performing, how are things going, what are your debts, what are your assets, what projects are you working on, what are you paying your directors, everything. Screeners are things that they're filters. That just means filters. And let's say, for example, if you were online and you were searching through a bunch of companies, but you were like, I don't want to deal with any company that's got high debt levels. That's just never going to be on my radar. I've got no interest in that. I don't need to gum up my search with old, bad, debt-ridden garbage companies. So you set a filter that removes all high debt companies. And then you'll be left over with the balance. Then you want companies that are growing at a rate of a minimum of 10% per year. So we'll filter that out. Boom. Now we got debt-free companies that are growing at 10% a year. Now you've got a filter running. So now you're screening stocks. This is what they are referring to. You can have your own set of views. There's no right way of doing it. You can like high cash flow companies. You can like low debt level companies. You can like whatever you want. Cool thing about markets is there's no right or wrong. I can look at the chart and say, oh, definitely going up. And you can say, oh, you're crazy. It's doomed, man. You're going to lose all your cash. Who knows? But at the end of the day, someone's going to make money and someone's going to lose. So we are going to know in the end. Okay. Discounted cash flow. Okay. A DCF is it's essentially a set of processes that tries to estimate future cash flows of the business into the current time period. I do not think that that is relevant to you in this competition. It is something you can look into one day, but it's not going to help you for this term. So look into it if you're interested. It's just a simple case of trying to estimate what the current value of the company is based on the future earnings, growth expectations, and historic earnings. This is where you will see things like black skulls, these aspects of finance as well. You will see them in the options version of DCFs, but yeah, we'll move past that. Okay. You want to buy stocks, obviously, like we've said here, you want to buy stocks at relatively low PE levels, relatively low price to books, and high dividend yields. Dividend yields, very easy. If the company is trading at 100 Rand a share and it pays a 10 Rand dividend, that's a 10% dividend yield. What's cool about dividends, though, is people often talk about how money compounds, how shares compound. But do you know that gearing, or rather dividends also compound? So, for example, if you were to buy a share at 100 Rand, that's the share price. And that share price provided you with a 10 Rand dividend, that share. If that stock price went up to 200 and a new trader bought that stock, their dividend would be 5%. Yours would stay 10%. And if the dividend increased from the company, yours would go up at a far higher rate than the other individual. So you've got a lot of ability to control and increase dividends actively in markets, not simply by finding a share that's got a high dividend. There's a heck of a lot more that you can do to increase your yield in markets actively and productively and proactively. It is about the efficient allocation of money. Okay, so they say build a watch list. Okay, so you build a watch list of all the cool shares you found on your stylish screener. You try to focus on your circle of competence, which is what Buffett used to refer to. He says, I don't know about certain things. I don't know about AI. I don't know about chips and microchips because he's 1,000 years old. But what he does understand is insurance companies, banks, old guy stuff. And look how well he's done. Because he played to his strengths, is essentially what he's saying. Circular competence. Play to your strengths. If you don't have any strengths, find one. Look to stable companies in consumer goods and utilities. Okay, consumer goods are basic things that people need all the time, like a couch or, washing machine, that kind of thing. It's not really going to change. If there's a global depression, you'll still need a couch, but you might not need an iPhone. So those are consumer discretionary items, where consumer goods are just normal things you need all the time. Another thing you need all the time is electricity. So utilities are things that provide you with your basic human needs, like water and electricity and internet. If it's not on the list, it should be. Then we've got competitive advantage. Okay, this is a major one for Buffett. You're looking for a company that can sell something that other people can't sell. So, for example, if you sell a commodity, like if you buy wheat, do you really care where your wheat comes from? Or do you just want some cheap wheat that's good wheat? But if you want to buy a Coke, which company you're going to have to buy it from a particular company. You can't just go buy a Coke anyway. You're going to buy this guy's Coke because that's what you want. So that is a competitive advantage. It's also called a moat around like a castle where no one can get in, no one can penetrate it because it's a brand. It's a right, it's a privilege that only they have. Apple holds a similar position in the minds and hearts of humanity. There are lots of companies like that. KFC, while they do sell a commoditized product, they've actually turned it into quite an exclusive thing. No one can sell you KFC but KFC. But things like iron ore and manganese, nobody cares. So those guys have no competitive advantage. An airline struggles to have a competitive advantage because really you only care about price for the most part if you're flying to Joburg. Let me just give you guys a couple of answers on the group here. Well, the data, I peruse the markets all the time and I peruse the news websites. So the data comes from investing.com. For the most part, you will use investing.com because it is cheap. It's free and it is excellent. The charting we'll look into a bit later with the technical analysis section. But yeah, we'll go through that website. I want you guys to actually really have a good look at it and see what it's like. And it's an incredibly good free resource. It blows my mind. There are a couple of them that are great. And then I also, Twitter is a very popular resource for the trading community in South Africa. You will find 99% of them there. Yeah, Coke and Pepsi are excellent businesses. I actually recently purchased Pepsi because it's had such a hard time lately. It had an excellent CEO for a long time. Coke, Coke and Pepsi, they're just behemoths. The problem is that the world is kind of at the moment kind of turned against sugar. So those shares have really not had the normal good time that they'd had leading up to that. These companies went directly upwards for 20 years. And then a few years ago, they started to have a wobble because the world just became more health conscious. And let's be honest, it's sugar water. It's not the best thing in the world for you. Anyway, okay, so qualitative factors, competitive advantage, management quality is a high focus for value investors. You can do a lot of damage to a business if you're a bad manager. Buffett tries to find companies that are so exceptional that they could actually survive a bad manager for a time. But at the end of the day, he always tries to meet the managers of the companies that he purchases, because it is vitally important to Buffett that the management are sound and reliable. And you don't want to have to deal with them. You want to let them do their job. Buffett is a hands-off kind of person. He wants to, that's not his thing. He doesn't know how to be the CEO of that company. So he's an investor. So he buys the stock, and he's happy with, he buys it happy with the management already. He don't want to come in and change the management. He wants to use the management. He wants to get them to do what they do, and he will enrich himself through that. Quantitative factors. Okay, you obviously want to look at some time period of the financials. If you're a value investor, you want to see if you can find a trend. Is this a consistently good company that's had a really hard time? I'll give you a quick example. This is Chevron, the giant oil company. Now, this company has been around since 1879, if I'm not mistaken. Now, this movement here on the chart represents a 30% fall in the share price of this company. Only it didn't happen really over that period. It really happened over this tiny short period here. So you've got a situation here now where you've got this enormous economic engine that is our friend Chevron, one of the world's largest energy companies, $250 billion. And in the last 146 years of trading, it's lost 30% of its value in 2% of its total trading history. Trading is about finding, and particularly value investing is about finding opportunities that are focused reductions in price relative to value. Price is what you pay, value is what you get. Okay, DCF's boring. Okay, you want brands, patents, etc. You want things that will make the company come back if it struggled. You want to buy good companies that have competitive advantages, that have moats, that have brands, and you want to buy them at a time that they're unpopular. Be patient, hold positions for years, ignoring short-term volatility, reinvest the dividends. Monitor fundamentals, not daily price movements. Hard to scare these people out. These people are the bravest of all traders. These people are the ones who buy pain and they sell hope. Stocks that appear cheap but have declining fundamentals are called value traps. So a lot of value investors will buy a stock thinking, hey, it's come down a lot. Must be a value stock. Meanwhile, it's just trash that's crashing. And you keep buying this trash. And then it goes down, and before the end, it's gone to zero and it's taken half your money with it. So you've got to be able to determine between a company that is a value proposition and a company that is a value trap. The value trap will just be a terrible idea. So it's very hard to tell the difference, because you've got this good company that's collapsing in the stock market. You're hearing the news reports, everything's going straight to hell. Now you're supposed to buy this thing and think to yourself, I know something no one else does. I've got faith in this company. And then it's got to turn around and you've got to be proven right in the real world operationally. Alternatively, it can just keep coming down. So you've got to have a very high personal conviction, bravery, courage, and strength of will to practice this type of trading. That is why Buffett is so respected, because everybody knows that he walked alone to this wealth. He didn't walk with all the other people. He did it by buying the things they hated and selling the things they loved to them while they loved it. And that's why he's got all the money now, and he's Warren Buffett and they're nobody. overestimating intrinsic value. These things should be self-evident, obviously. If you buy something that is way over your intrinsic value expectation, you should expect it to fall. At least it will prove that you were right in your estimation of its value. But to buy it above what you perceive to be a good deal is very foolish. If you go to macro, like it's market's weird. You'll watch people all the time. They'll be like, oh, it's collapsing, I've got to get out. Or they'll be like, oh, it's rocketing up, I've got to get in. I mean, like, if macro phones you tomorrow and tells you there's a 50% increase on the price of the plasma TVs, is that going to get you to run out there and go buy a TV today instead of tomorrow, instead of the next day? Is that going to do anything to motivate you to do that? But it seems to for the market. And if macro phones you to tell you that the TV's on a 50% discount, then you throw your TV away. I mean, that's why I say you have to invert your mind. You have to invert your problems. Everything has to be flipped around in markets. Because if the market goes from bottom left to top right over the course of the last 100 years without fail, why is it that 87% of traders lose money? Because it's really just not about the market. It's not about the direction of the market. It's not about the prices. It's not about the news. It's not about the wars or the inflation or the gold. It's just you. You in your mind, in your heart. And you can spend your time in this world. You can pretty yourself up and you can put makeup on. But you can't take those parts of you into the market. You can only take your core being, yourself. And if you succeed there, it's a great reflection on you because you couldn't fake it. There's no shortcuts, no tricks. You either make the money or you don't. And you're competing with the smartest, most well-informed, most incredible people in the whole world. The winners of the winners of the winners. And you could go in there with absolutely nothing. And just as easily as him, take it all. It's totally up to you. If you have what it takes. Okay, value investing is a disciplined, patient approach that rewards those who focus on fundamentals and ignore market noise. By understanding intrinsic value, applying a margin of safety, and staying committed to the long term, investors can achieve consistent returns. The key is to treat stocks as ownerships in businesses, not as speculative tickers. Tickers are the reference that a stock has on the market. So, for example, a stock that was, say, Netflix would be NTFL, for example. Probably FX, but yeah, you get the idea. It's just a reference to the stock itself. Price is what you pay, value is what you get. That's another one I referenced earlier. That's what Buffett loves to say. You've already worked out how to do all of this, blah, blah, blah. Okay, cool. That's value investing, guys. That's a general idea. It's a very good policy to have. Remember that these things, you don't have to lot yourself into one of these policies or processes. They're all very different. Most investors will have like a portion of their portfolios that they apply the value investing ideology to. They'll go find some really good shares. They want to put it in the bottom drawer, leave it alone for the next 10 years. Maybe that's 50% of their money. Maybe that's 80% of their money. And then 20% of their money, they're a little bit more speculative. Maybe they're using our next thing, just technical analysis. Okay, so let me just give you some basics on technical analysis. Technical analysis is all the charting stuff. All the charting, it's all the stochastic oscillators you've heard about, it's all the volume, it's all the candles, it's all of that type of thing. It is a quantitative method, not a qualitative method. Obviously, our friends there in the value investing section They are purely qualitative. Now we're in a purely quantitative process. This is the artistic part of trading that I spoke about earlier. It's based on a concept which I'm sure you've all heard of, which is the efficient market hypothesis. It says that all of that stuff that we were talking about before in the value investing section, there's no need to do any of it because it's all in the chart. It's all expressed mathematically as a spot price. Boom. Every single piece of information in all the world is somehow combined into the price. Whether this is true or not is constantly debated. People ask if that is true, then how can there be men like Warren Buffett? How can they be so able to move out into the tail, into the skew, if it's all just in the price? I'm of the view that it is in the price in the short term, but not in the long term. So technical analysis is a method of evaluating securities by analyzing statistics generated by market activities, such as prices and volume. Unlike fundamental analysis, which focuses on a company's financial health, technical analysis seeks to predict future price movements based on historical patterns and trends. So it's all about pattern recognition. Yeah, you can already see that this is a different type of human mind. And it's just as valid as the value investing section. But you don't need to be a number crunching nerd, value investor all the time, and that's the only way to trade. You could have a completely different artistic, quantitative, statistical approach. You could be a person who finds patterns more readily than you calculate numbers. Many things, you could be a person who finds patterns in financial statements or a person who finds patterns in charts, and the two respective individuals could make a completely successful living on the market independently of one another, independently of one another's information. It's 1,000 approaches. We won't cover all of them. Okay, so technical analysis. Today, core concepts, tools and strategies, and practical examples. Okay, so technical analysis is about price movements, and it is about the analysis of how traders on the stock market interact and what levels on the chart have a tendency to cause price actions to change or change, let's say, either change direction or change velocity. So maybe we're getting to some kind of a level on the chart where we feel that if it breaks through this level, it's blue skies, it's to the moon, guys. Or it hits this level and it runs out of buyers and boom, you're sending the Lamborghini home. Okay, so it can be extremely useful in trading. This one is it's not necessarily designed for the short-term traders, but it is a lot more handy in the traditional trading than you would find long-term value investing would be, because investing and trading are mostly just separated by the term you're doing it for. It's referred to as your time horizon when you're thinking about investing. You can use stock charts, forex charts, commodities. You see, with value investing, it's very hard to figure out what a piece of rock's worth. So they don't get a lot involved in things like gold. Like, how do you value gold? Surely it's valuable in some way, but what am I going to study? The financials of gold? No. What moat does gold have? Does it have a competitive advantage? Does it produce any revenues? No, 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 no. So they tend to not touch that stuff. But when it comes to technical analysis, charting, everything's fair game because everything gets represented graphically. And if you know how to read a graph, or what we call charts, it won't really matter what you're looking at, will it? all you really want to understand is, will it go from there to up, or wherever you may want it to go? So the ideas are that price discounts everything. Like I said, the efficient market hypothesis, modern portfolio theory covers this concept, says that the market is a perfect pricing mechanism at all times. 100% of the time, it's 100% perfect. There's no advantage that one can derive, no edge can be derived in any way, shape, or form. All you can do is follow price action and try to make a determination as to where the stock will go based on previous price action. Trends are a major part of what these folks do. They try to get into a position of a trade. They try to gain exposure to a trade just before a long run. And then after the run, they want to exit. Or they want to see again in the future, will it have a second run? And then they're making these decisions as and when they go. Okay. Will it reverse? Will it continue? Trends, So patterns, trends, this kind of concept. Very simple stuff. We'll look at the actual charts. We'll see, are there any trends here? You can see we've got a high, we've got a high, we've got a high, we've got a high. You can already see minor, simple connections between things like this. You will learn to see these things intuitively. In 1 second, there, we matched it over there. We matched it over there. We matched it over there. Matched it over there. We matched it over there. And so on and so on and so on. It's very therapeutic. I've always found charting extremely therapeutic. It's a wonderful way to, you just take your time, you work it out, you move your lines around, you see if you can find anything. You can use the tools on these platforms. They are extremely good. They will help you find certain targeted outcomes you may have. A lot of these tools are based on mathematical ratios and based on statistical concepts, which you'll be very familiar with, like standard deviation, rate of change, volume. Nothing hectic. Even though there's a lot you can look at here, this is the world where most traders are most of the time. So, and it's quite a technologically driven one. So it has a lot of options, and every conceivable format of data you could ever dream of is available to you should you require it. If you were like, wow, I really wanted to know what's the volatility specifically of this company or whatever, you can figure that out using the charts. They'll have all of these incredible tools. You can change the lines into fashions that you prefer. You can see the volume. You can see here we had a high volume day on this company. This chart is in fact monthly, so you can change it so that you get days where you see the share price movement per day, or you see it per hour, or you see it per week, or you see it per month for a very long-term view. We're still on Chevron. This, up to this, was $300 billion of wealth creation out of interest. Okay, so lines on charts, bar charts, candlestick charts. So when people talk about candlesticks, what they're talking about are these things. These candlesticks show you the range that the stock traded, or the commodity or the currency, over the period referenced above. So this candle is 1 month of price action on the 2nd of the 5th, 2022. So this is May 2nd, 2022. Over here, we're in the current month. So you can see that pretty much the worst month that Chevron has had since this month in 2023, November. You can use the charts to tell you these types of things. You can see how often does it have a bad month? How long does the average rally last for in time and in scale, etc., etc. You can see that we have a support and a resistance level. You've got a stock that's heading up into this resistance. Then it heads up again into it. Then it tries a third time, and finally it breaks it. Then it breaks out of it. Then it comes back to it. The same blue line. The question is, now will this happen? Or will this happen? Who knows? Time frames are very important. We all trading stocks, but there's a very different mindset, not just in the ideologies you practice in trading, like the ones we're discussing today, technical analysis, value investing, but also the time frame. You could have the same approach as another guy. You could both, for example, be technical analysts, but he could be trading in months to years, and you could be trading in minutes. You have virtually nothing in common other than the general ideology that you approach the markets with. But the number of things that are impacting him versus the number of things that are impacting you is a completely different world. So you will be, over the course of your investment career, you will come to, your nature will just tend towards being the kind of person who trades weekly or daily or monthly. Depending on sort of your own mental harmonic process, you will end up being comfortable as I'm personally a swing trader. I trade over the course of months, certainly not days, especially if you're a new trader. The shorter the time period, the more challenging the trade. Why is that? It's the same as in any statistical analysis. If you were trying to figure out, how many people on average liked ice cream, you wouldn't ask 10 people, you'd ask 100,000 people. You'll get a much more specific answer on the exact number of human beings out of every 100,000 people who like ice cream. So it's a similar thing with terms on charts. If you've got a tiny sample size, you can derive less data that is useful from it. But it also means the other guys can derive less. So you could maybe have a better chance of beating them. However, in the long term, you will probably struggle. So the longer the term of the chart that you look at, the more reliable the information from which you derive. Okay, questions. Yeah, here's the cool thing about the AI. The AI has actually come to show something very interesting in markets, something we weren't necessarily aware of previously. AI is extremely useful in the process of learning investing, and it's very useful in the process of researching investing or researching companies. But AIs cannot trade stocks. They have proven to be incredibly ineffective at it on a sustainable basis. So the value of AI when it comes to investing is, like I said, no shortcuts. You can use the systems of AI to learn very much more quickly than my generation learned, because your access to that data is 1,000 times better. But at the end of the day, um, it will be you alone in the market, just like the rest of everybody. But I strongly suggest using AI as a tool of investment, no doubt about it. If you don't, you will fall behind everyone else who are using it. Just like AI in general, in fact. Okay. Support and resistance. I've explained support and resistance, basic concepts like this. We won't go into too much detail on that. Obviously, there's, you know, I know people who have dedicated their entire life on this planet to this one ideology, this one process of investing, technical analysis. And then I know guys who've done the same thing with the value investing. So you're going to spend a little bit of time for the rest of your life learning about all of them, should you move in that direction. But you'll never know it all. And that's the best thing about it. No one can know it all. No one can be a master. No one can be so much better than you that you have no chance of ever being as good as them. That's not true in real life. Some people can have a better start than you, so far beyond you that you've got no chance of ever catching them, even if they do nothing. That's not true in markets. Day traders are traders that trade daily. Swing traders like me trade monthly. Position traders are people that hold the share for a very, very, very long time. So they're not really investors, because they're not going to do a Buffett and hold it for 20 years. If it gets a bit expensive, they're gonna can it. But this is what most good investors fall into: swing traders and position traders. I don't know a lot of multi-millionaire day traders. Do you? Okay. Key support resistance. Buying near support, selling near resistance. This is intuitive stuff. I think that if I don't want to waste too much time telling you these basic things. Like I said, this is just a guideline. I'd prefer you learn that in your own time. It's very basic. What's important here is to understand that it's about recognizing channels, recognizing patterns, recognizing flows, and looking to see where you think there will be periods of highest trading density on the chart. There will very likely be more volume traded on this stock at this specific price level. Here is a random section of chart. We have a random section of chart running up here. This section here. Who knows what's going on? Who knows when it's going to start, when it's going to stop, etc. But once we get to this kind of a section here, we can see, anyone can see, which means they are seeing. Funny business is happening here. Opportunity is happening here. Or disaster. One of the two, but something's happening. And then you are going to spend time learning the nuances of the universe of events that occurs within this little blue line. Many opportunities in this little blue line. Crossovers and support and resistance. Okay, crossovers are references to moving averages. Moving averages are an average of the share price over time. If one's short-term price average moves above one's long-term price average, that is an indication that the short-term trend has risen faster than the long-term trend has risen. It therefore gives you an indication of a structural shift in the sentiment and price action of the stock over time. And that seemed to be a bullish thing. Some people consider it bearish. The point is, it's showing you that the nature of the stock's personality for the time period is changing. Maybe sentiment is changing. Maybe things are turning around. Pick n Pay is a very similar story in South Africa at the moment. Had an absolute dog show of a set of results a few years ago. Everything went very badly. And then they brought in new CEO and things are slowly turning around. And now the price action is looking solid and the moving averages are turning around and everybody's happy. Volume is extremely important. Volume relates to how much of a stock is traded on a daily basis. If volume is rising, it's generally a good sign. It's an indication that validates price action. So if a share price normally trades at 100 and for some reason the share price pops up to 150 and everyone in the stock has made a 50% profit today, well done. Meanwhile, you look and it's like 2 shares that have traded. It was a freak trade. Some person pressed the wrong button or something like that. You couldn't have sold into that. It's not real money. Okay. So it's got to be volume based. You've got to actually have the volume behind the movement, confirming the movement. If the earnings come out of the company and the volume is high and the share price is pushing higher, then you know it validates that movement. If it was just popping up with nothing underneath it, you might want to be a bit concerned. You don't want to go flying into that share. Also, you'll find that volume's extremely high on selling days. If you come out with bad news and it's a catastrophe or something, then we end up with the situation where you've got an issue. So volume analysis, that's cool. Relative strength is, okay, the RSI is the relative strength index. What it hopes to tell you is that a stock, you don't necessarily have to look at a stock on an absolute basis. You can look at it on a relative basis. So a rising tide lifts all ships. So if, let's say, for example, you were to buy 5 stocks and those stocks were to go up by an average of 20%, but the market went up by an average of only 10%. Everyone could go out and say they made money. Everyone made at least 10%, that you made 20%. So relatively speaking, you did better. Some shares can do better than other shares on a price basis on the market. So if the market's running and you're trying to figure out which shares are cheap, but hell, everything's gone up. Okay, which ones have gone up the most? Which ones have gone up the least? We're now seeing them relative to one another. So we're seeing them in their own context of being a share in an ocean of shares. You know, you're not necessarily a genius. Maybe it's just a bull market you bought into. Reversal and continuation, we've spoken about. Triangles and pennants are simple chart formations, okay? So things like this. We'll look at this company. You will see that there are formations that occur on the chart. This kind of thing. You will see them all over charts. They are short-term chart formations. There are many names for them. There are many types of short-term chart formations. Some of them are called flags. They're called pennants. They're called any number of different references that they'll make. There's a whole world of them to learn about. It's not really within the scope of this conversation to explain them all to you, but they're basically just little means by which to see or to judge what you expect to be short-term price action. So 2 guesses what this falling flag indicates: a breakout. Then it falls in the flag and a breakout. And it falls in the flag and a breakout. And then you buy it on that one, assuming you were right for a 4th time, and it got you that time. Sorry for you. So that's how charts work out. It'll work every time, except the time you do it. But that's part of the fun of it, keeps you on your toes. Not that I'd ever have bought it at that price point, but anyway. Okay, so then you get breakout trading, pullback trading, and trend trading. So we've already talked about breakouts popping above the support and resistance levels. We've got the pullbacks, which is the opposite. And then we've got trend following, which is you're basically just trying to stay on this boat over here for as long as possible before it capsizes. Remember, they always capsize. The question is when. And I mean, if you were on this boat for the rally, you would have made a potential profit of 45% in 1 year. 2023, half a year. 2023, 10 months, 2024, 4th month. So if you optimize it, you can make, that's like what? It's about 10 times a bank account savings return for the year in 6 months, which is then 20 times the bank account's return for a year. And you had your money in a place that was able to generate money that efficiently relative to something else. So what the market is about, I always use this expression, it is about becoming the person who can squeeze the money out of the rock, more money out of the rock than the next person. So you will receive 1,000 Rand, your friend will put it into a savings account and make 7.25%, and you will put it in here and you will make 45. And because this is a place where this can be done, and we live in a world where clever people will therefore come to this place, we find a lot of the money is ending up with the wealthy people. It's not because they are smarter or because they are wealthier. It's because they're in the right place. They're at the source of the money, while you scurry around playing with all the things that already exist. These guys are not competitively minded people. They are creative people. They don't distract themselves with that kind of old thinking that you have to become competitively attractive to be successful in the modern world. The idea that you have to follow this very defined process to ultimately create a value proposition to the world that will guarantee success. It will enable and empower you, but it will be no good if you don't educate yourself on the broader systems in which you live. And through these means, your existing education in business can be vastly magnified in its value to you, its usefulness to you, because you, as a specific demographic, even in the university, have an advantage. You obviously have an innate tendency to like this type of thing. You didn't get, that's just in your heart, in your mind. You didn't choose that. You didn't get asked if you wanted that. You just have that. So you're very lucky because, some people might be really talented at making molehills and it's just useless, But this happens to be the most important thing in the world. as far as its impact on your personal finances, as well as broader society, it is comfortably the biggest impact. And you just happen to be born with a passion and skill set and a tendency and find yourself at a great university studying with great people who've brought you to learn about this. You are in the top percentile of the top percentile of prospective people in the world right now as you sit here. Just by virtue of being connected to these facilities and these resources. You know, there's a guy sitting on an oil rig somewhere and he's earning 50 grand a month and he's doing well, and he's not seeing his family. He's not seeing anybody. The water's splashing him in the face right now. It's freezing cold. The sharks are circling, right? Then there's another guy. He's parking off there at some facility here in Port Elizabeth, some nice air-conditioned office. He's earning 50 grand a month. And he's doing his job. He's typing away in his spreadsheet. They're both earning the same amount of money. They're both providing the same exact amount of value to society. But the one guy's got a much better life. There is a way to get rich. There is an easier way. It's not a lazy way. It is the opposite of lazy. It is a clever, useful way. This realm has none of the limits that our physical world has. Here, the people don't complain. We don't compete. We create. We don't go back and say, no, that didn't happen. If you sell a property in the real world, you're going to get a call after you sell that property and they want you to change something, and you got to update the deal and change this situation and negotiate, renegotiate. Or it's a staff member who's sick. I can't come to work. My dog's goldfish died. I can't do it. Once you sell the share, it's done. It's finalized. It's forever. No one knows who you are. No one cares. Who's got the money? You or him? End of story. Boom. Pure finance. 100% pure. Simple, straightforward. If you master it, you will succeed. If you are a good business person, you still may not succeed. You may get unlucky. Your husband could get sick. You might have to spend all your money on making your husband better. Maybe that sends you into a failure situation. Doesn't mean you weren't a great businessman or great businesswoman, but you end up in that situation. The market doesn't work like that. Nothing will happen. So long as you keep your financial aspect of yourself, this specific part of yourself, if you separate it from yourself and you set a rule, you say, I'm going to put 300 Rand, just say, for example, into investing every month. Nothing's going to stop that from happening. It's a completely manageable amount. I have no excuse to not be able to put just that little amount in. So I'm going to make sure I do that. And then you're never going to draw that money. Ever, ever, ever. You're going to put it in and you're going to watch it grow. And it's going to grow independently of you with all of the advantages of this realm, unimpeded by your weakness and your failures and your health and your stress in the moment. They'll just carry on. And if you keep on taking care of them, just look at them from time to time, make sure you get a good set. They'll really do well for you in the long term. And the more of yourself you move into this place, the more productive you will become. As long as you apply the right principles, you don't get stuck in that sort of gambling mindset. But I don't think that you are that kind of a group of people, because you are obviously serious people. That's why you're here on a Saturday morning. Thank you for getting out of whoever's bed you did last night. It's fantastic that you were able to be today and take the time. I think we need to have a little bit of a break now, maybe. And then, yeah, we'll come back to it in a little while. And we'll move on from our friends here with technical analysis. There's still a bit of extra stuff here, but I think it's not too relevant to you. Limitations, etc. You can learn about them. False signals, lagging, etc. Yeah, no, nothing necessary for the rest of this one. So we're cool on that one. We'll move into growth, and we'll try to polish the next few in a little while. How long are we going to take? 15 minutes? 15 minutes, guys. We chat none.